In early 2025, thousands of U.S. startups raised money. The headlines were optimistic, the valuations were aggressive, and the founders believed the hardest part was over. But almost none of them noticed something strange. Not a crash, not a panic, not a warning from the news. Just a quiet shift in how money was behaving. Because historically, recessions don't announce themselves to the public first. They show up inside balance sheets, board meetings, and budgets. Months earlier, by the time the word recession becomes common language, funded startups have already locked in the decisions that decide whether they survive it. This isn't a story about fear. It's a story about timing. And the companies that survive aren't the ones that predict recessions. They're the ones that recognize the signals everyone else ignores. In 2026, those signals are already moving. Every recession creates the same illusion that it was obvious in hindsight. People later say, of course it was coming. The signs were everywhere. We should have known. But inside companies, it never feels obvious. In 2000, startups believed users mattered more than revenue. In 2008, businesses trusted credit would always be available. In 2020, companies assumed growth could outrun uncertainty. Each time, smart people made logical decisions based on assumptions that quietly expired. What makes the next downturn dangerous isn't panic. It's confidence built on outdated rules. And for funded startups, confidence is expensive. The first sign of a recession inside a startup is not falling revenue. It's hesitation. Deals don't collapse, they stall. Customers don't cancel, they circle back. Hiring plans don't stop, they get delayed. Founders often dismiss this as noise, seasonality, bad timing, a slow quarter. But hesitation is behavior, not opinion. It's customers protecting cash before the economy officially tells them to. The startups that survive are the ones that treat hesitation as data, not inconvenience. Ironically, funding can make startups more fragile. After a round closes, pressure shifts. Burn replaces discipline. Growth replaces efficiency. Optimism replaces skepticism. Boards expect momentum. Founders feel urgency. Teams expand faster than systems. This works in stable markets. But during economic shifts, fixed costs don't slow down. They wait. And when revenue hesitates but spending doesn't, time becomes the most expensive variable in the company. Most founders believe recessions kill companies by cutting demand. In reality, they expose companies with no margin for error. Startups that survive don't just sell products. They sell flexibility. They can slow hiring, pause expansion, renegotiate contracts. The ones that fail are locked into decisions made during optimism. Leases, headcount, marketing commitments. That can't be undone fast enough. Recessions don't punish ambition. They punish rigidity. The second signal doesn't come from customers. It comes from capital. Not in headlines, not in public announcements, but in tone. Investors stop asking about growth velocity. They start asking about burn multiple, runway, path to profitability. At first, the questions sound reasonable, even responsible. But historically, this shift always happens before recessions are publicly acknowledged. Capital doesn't panic early. It recalibrates quietly. In past downturns, startups that noticed this shift early had options. Those that didn't ran out of time. Because once capital becomes cautious, it doesn't reverse quickly, and founders who assume we'll just raise again are often betting against cycles that don't care about confidence. Many founders respond to uncertainty the same way. They wait, they delay decisions, they hope for clarity. They assume more data will make things obvious. But recessions punish hesitation more than mistakes. History shows that companies that survive downturns don't wait for certainty. They act on probability. Because by the time certainty arrives, options are gone, costs are locked, teams are sized, contracts are signed. Wait and see feels safe. But it quietly converts flexibility into fragility. The founders who survive are not reckless. They are decisive early. Inside startups, the third signal isn't financial. It's behavioral. Teams slow down. Ownership blurs. Meetings multiply. When uncertainty rises, productivity doesn't collapse. It diffuses. People hedge. Managers overcommunicate. Decisions escalate upward. This is rarely discussed publicly, but it shows up in postmortems again and again. Startups don't fail because teams stop working. They fail because teams stop deciding. And during economic shifts, indecision compounds faster than losses. Recessions expose something brutal. Revenue is optional. Costs are not. Startups built during optimistic cycles tend to optimize for speed, not resilience. High fixed costs feel invisible when growth is strong. But when growth stalls, they become immovable. Office leases, vendor commitments, software stacks, long-term hires. Each one makes sense individually. Together, they remove flexibility. The companies that survive downturns don't eliminate ambition. They preserve maneuverability. Layoffs are often framed as decisive action. In reality, they're usually reactive. By the time layoffs happen, the problem is already structural. Revenue slowed months earlier. Costs stayed flat. Runway quietly shrank. Layoffs don't fix broken economics. They buy time. And time is only valuable if it's used to change direction, not wait for conditions to improve. The startups that survive recessions reduce risk before they reduce headcount. In every downturn, a small group of founders act early, not because they predict the future, but because they read the present accurately. They cut burn when things still look fine. They slow hiring while competitors accelerate. They prioritize cash over optics. At the time, they look conservative, even timid. Later, they look inevitable. These founders understand something most miss. Survival is not about being right. It's about lasting long enough for conditions to change. Across multiple recessions, one decision appears repeatedly, whether to preserve cash or chase momentum. It's rarely framed dramatically. It shows up as one more hire, one more market, one more quarter. Each choice feels small. Together, they decide who survives. No one knows if 2026 will bring a recession, but history doesn't require certainty. It shows patterns. Tighter capital, higher scrutiny, longer sales cycles, slower risk appetite. These patterns always arrive before official labels. Founders who wait for headlines are reacting to the past. The ones who adapt early are designing the future. Most funded startups believe they're safe because of one number, the amount in their bank account. A recent raise creates psychological protection. It makes risk feel distant, abstract, but cash doesn't equal safety. Timing does. In past downturns, many startups fail with millions still on the balance sheet, not because they ran out of money, but because they ran out of options. They committed too early, locked themselves into growth assumptions that no longer held. Safety isn't cash on hand. Safety is how quickly you can change direction without breaking company. When capital tightens, the most dangerous position isn't low runway, it's rigid runway. Founders who confuse funding with insulation usually discover the difference too late. Optionality is the ability to choose, to pause hiring, to pivot pricing, to walk away from a bad deal. During expansion cycles, optionality feels unlimited, but every decision quietly removes it. Long-term contracts, aggressive headcount plans, single-channel customer acquisition. None of these are fatal alone. Together, they hard-code assumptions into the company. When conditions change, startups don't collapse instantly. They suffocate because they can see the problem, but can't move fast enough to respond. This is why downturn survivors often look boring in hindsight. They protected optionality when others optimized for optics. During uncertain periods, metrics become unreliable, not because they're wrong, but because they lag reality. Revenue doesn't fall immediately. Churn doesn't spike overnight. Pipelines look healthy until they don't. The danger is believing today's numbers represent tomorrow's behavior. In recessions, decisions change before data does. Customers hesitate quietly. Budgets freeze informally. Procurement slows without announcements. By the time dashboards reflect this shift, The window for gentle correction is gone. The founders who survive read signals, not spreadsheets. They watch sales cycles lengthen. They listen to tone changes in conversations. They notice hesitation where confidence used to be. When researchers analyze companies that survive downturns, the pattern is surprisingly consistent. They simplify, fewer priorities, clearer ownership, stricter capital discipline. They reduce complexity before reducing ambition. Instead of chasing new markets, they deepen existing ones. Instead of maximizing growth rate, they minimize fragility. These decisions rarely make headlines, but they create companies that don't panic when conditions worsen because they already adapted. Across multiple downturns, one internal document keeps appearing. A brutally honest runway model. Not optimistic, not investor-facing, not aspirational. It answers uncomfortable questions. What happens if revenue stalls for 6 months? What if fundraising takes twice as long? What breaks first? Most founders avoid building this document. A few don't, and those few usually survive. The founders who act early face resistance. From teams, from boards, from peers, because acting early looks pessimistic, until it isn't. History rewards founders who are willing to look wrong temporarily, to avoid being wrong permanently. They make unpopular calls quietly, and explain them later. Whether a recession arrives in 2026 isn't the point. The preparation window is. Economic cycles don't announce themselves politely. They reveal themselves through pressure, and pressure always arrives before permission. The startups that survive don't wait for confirmation. They move when signals align. In every downturn, there's a defining difference. Some founders protect the story of growth. Others protect the reality of survival. Only one compounds. Recessions don't kill good companies. They expose weak assumptions. And the founders who understand that don't fear what's coming. They prepare for it. The startups that survive are always the ones who see the risks before anyone else. If you want to know the moves, the decisions, and the warnings most founders miss, subscribe now and turn on notifications. This is where the real stories of money, power, and survival unfold, and you don't want to miss the next one.